Hello traders, welcome back. Today we're going to be doing an update on our EUR/USD forecast where we left off. In the previous video, we had this long wick doji candle which signaled a potential breakout in either direction. Since then, prices continued to move lower, forming what appears to be a bearish engulfing candlestick. This is exactly what we were expecting in terms of a reaction from that doji, and it's exactly what price did in the previous time frame. If we zoom out a bit, we can see that there's actually been quite a lot of bearish engulfing candlesticks in this down. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. There's a lot of bearish engulfing candles in this down, which means that each of these candles are getting progressively larger. This is typical of a trend that's gaining momentum. So at this point, our bias is clearly to the downside. The only thing that could change this is if the next candle breaks back above the previous high, which would then make it a bullish engulfing candle. If that happens, then we would have to wait for a bullish engulfing to close above the high of this candle here to get into a long position. So far, that hasn't happened. In fact, price actually broke back below the low of this candle, which makes it a double bottom and gives us even more confidence to enter a short position. The next level of support isn't until 1.06200. That's quite a bit lower from where we currently are. But considering how strong the momentum is to the downside, we wouldn't be surprised to see price continue to keep dropping. This is why it is important to have your trade stop loss somewhere in the vicinity of the previous swing, preferably on the high of the previous candle. That way, if price does break through to the upside, you won't be stopped out because your stop loss is far enough away. Otherwise, if you have your stop loss down here, then you will get stopped out by this latest move. You might think that entering a short position now is too late, but that's not really true. Sure, you would have gotten a better entry if you got in earlier. However, there is still plenty of room to the downside, and momentum is still very much intact. What's interesting is that price came back up to retest the previous swing high, which is now resistance. Price ended up breaking through, but only managed to do so by a few pips. This tells us that sellers are starting to enter the market because they believe that this pair has gone down far enough. They know that the next level of support isn't too far away, so they start entering shorts here to bring price back up. Now, if price ends up closing below the low of this candle, then our short position will be considered a false break. This is because it was caused by sellers trying to push price back up. It doesn't represent real buying pressure, so if price closes below the low of this candle, then we will stay in our short position. Otherwise, if price closes above the high of this candle, then it represents real selling pressure and we will exit our short position. This is just one possible scenario. Another scenario could play out where price continues to drop right after this. If that happens, we will still keep our short position open. Our target for this short position is still the same, which is the low of the previous candle. From there, we would look for signs of a potential reversal to determine if we should keep our position open or close it. Alternatively, we could also set a trailing stop loss. By doing this, our stop loss will trail along with price, and we don't have to worry about false breakouts as much because our stop loss is dynamic and adjusts based on price movements. Alright, so those are the two scenarios that we're watching out for. Either price ends up coming back up to retest our support level, or it continues to keep dropping. If it does, then we will keep our short position open and ride it all the way down. Alright, that's it for this quick update video. Let me know your thoughts in the comments below, and I'll see you in the next one.